Hi folks, Chuck Gibson from Financial Perspectives in San Ramon, California with April 2017's Charts on the Move. I'll be splitting this month's video into two sections. In the first, I'm going to cover the basics of how markets move. While it sounds boring, this is in my opinion one of, if not the most important concepts all investors should know. With that understanding and knowledge, the second half of the video will be looking at a bunch of charts of the US markets and see what conclusions we can draw from the current market action. Let's get started. Quite simply, all markets do only two things. They either trend or they consolidate. Within trending, markets can either trend up or down. Let's take a look at an example of both. In a trend where prices are moving higher, on a chart you would expect to see prices start near the bottom left and end near the top right. In this chart of the US S&P 500 index, that is exactly what we see. I do want to point out that while it is trending higher, it hasn't done so in a straight line. As with any trend, there will always be consolidations or counter-trend moves, and the S&P 500 is no exception, as you can see. The biggest and most obvious is this one here, from the beginning of 2015 through the middle of 2016. My next chart, that of the CRB Commodity Index, is an example of prices in a downtrend. As you would expect, the visual would be a mirror image of those in an uptrend, as prices would start in the upper left-hand corner and end in the lower right. Exactly like those in uptrends, the trend does not follow a straight line, as there are many periods of consolidation, like this one here that lasted 6 months, or this one that we're currently in, which is pushing a year in length. Now see how easy that was? Now that we have the basics of trending down pat, let's take a look at consolidations. Specifically, I want to look at consolidations with the construct of a trend. Consolidations, which can also be referred to as corrections, are just movements in the opposite direction of the primary trend. These consolidations can occur either through time or through price. Those that occur through time look as if they're trapped in a range, with price action taking on choppy sideways movement. Prices bounce from the top to the bottom of the consolidation zone, and then they eventually break out. The second form of consolidations are those that occur through price, where instead of the sideways chop, price moves significantly counter-trend. Let's take a look at examples of each. Using the chart of the S&P 500 index, you can see highlighted boxes that outline 4 different consolidations. The first two at the bottom of the chart are consolidations through price. As you can see, they tend to move impulsively and further to the downside, whereas the upper two consolidations provide choppy sideways action and price consolidates through time. You may be wondering why I spend so much time following consolidations, when all the profitable action is when prices trend. Well, the answer to that is twofold. First is that price spends 60 to 80% of the time in consolidation, while the much smaller balance is spent trending. Secondly, and most importantly, is that at some point, consolidations eventually become market reversals. While it's been a long time since we've seen a true market reversal, I promise you, nothing goes up forever. Reversals are those things we desire to avoid because it's where investors can lose a lot of money. Let's take a look at an example of this with XLE, the energy sector ETF. You can see in this chart, XLE formed 5 consolidations. The first 3 were corrections or consolidations through price, whereas the next 2 were consolidations through time. Notice how the first 4 consolidations resolved to the upside as prices moved higher. The last one, as we will see in the next chart, had a different fate. This is the same chart as before, but I added one more year to our view. The inclusion of the additional year saw the top consolidation actually turned into a market reversal, which was borne out as prices fell almost 30%. As a sidebar, note how during this downtrend it had 4 periods of consolidations, all of which went through price, none through time. This is normal, and it's due to the ferocity of most declines. Consolidations through time usually occur only during uptrends. Additionally, I would be remiss if I didn't mention the difference in the amount of time the market spends in uptrends versus downtrends. In the case of XLE, it took only 2.5 months to wipe out what it took to make in a whole year. It's the old story about stairs up, elevator down. The takeaways from our look at consolidations are: 1. As investors, sideways consolidations through time are much more palatable than those through price. The problem is you have no way of knowing ahead of time what type of consolidation it will be once it starts. 2, consolidations, once they break out, imply a new trending period in the direction of the break. And 3, consolidations are times when investors need to be on high alert, as a break of consolidation to the downside, otherwise known as a reversal, are always a possibility and something we prefer to avoid because of the potential for large, fast losses. With all this newfound knowledge, let's jump into a bunch of US-based stock charts to see if we can garner the weight of the evidence-based market message that it's giving us. My first chart is that of the S&P 500 index. It should be easy to recognize we are in a time-based consolidation as price is stuck in a sideways channel trapped between support and resistance. As you can see, it sits just under the prior resistance level. A break above and hold would be bullish and an indication we are beginning a new trending period to the upside. If price fails to break out and instead falls and breaks below support, that would be bearish turn and would open the door for potential further downside. The next chart of small cap stocks is telling a little bit more cautious message than that of the S&P 500 index. The index gapped up and broke out of its consolidation to the upside earlier this week, but ended with a move back below support and back into the box. This, if it holds, is a potential failed breakout and would be the reason for concern, as small caps tend to be the leaders into new trends. As such, what this does over the next few weeks is worthy of keeping a close eye out, as it will likely set the stage for when and where the rest of the market goes. The next chart of financials, like the small caps, is a very important sector. Without a strong financial underpinning, the markets are going to struggle. I see 2 possible interpretations of this one though, one being more concerning than the other. The first, the more optimistic view, is financials, like the broader index, are in a consolidative box trapped between support and resistance and awaiting a catalyst to determine the direction of its next move. The second interpretation is where March's decline is a failed breakout warning, similar to what we saw from small caps. My next chart of the Dow Jones Industrial Average looks exactly like the S&P 500 index. Price is stuck in the consolidation zone and sits just under prior resistance, awaiting a catalyst. My last chart is that of QQQ, the Technology 100 Index. This chart, well, it's a thing of beauty. It gapped up out of its consolidation zone earlier this month and has continued to march impressively higher, even as the majority of the rest of the market is stagnant. This is very constructive. What we'd like to see, though, is all sectors breaking out to new highs, a confirmation the breadth of the market is in agreement, as all are moving together. The more stocks that are participating in the breakouts and new highs, the greater the chance the move continues. Unfortunately, right now, looking at my charts, we can conclude that the breadth of stocks at all-time highs is not healthy, and while not a sell signal, it adds an element of concern. But we need to give the benefit of the doubt to the underlying trend, so I expect we eventually will resolve to the upside, but probably not without further consolidation as a minimum. To close this out, the broader market currently sits at the upper end of a trading range. The longer we hold near these highs, the more likely it is that we break through that 2400 resistance on the S&P. But without substantive headline driving the breakout, I expect the buying to fizzle and prices to tumble back to the heart of the trading range. At this point, I suspect the only thing that will support a sustainable breakout is a news-driven event, such as the GOP getting their act together and coming up with a passable tax plan. Until then, expect us to stay in this trading range. The good news, though, is that if it fails to materialize, virtually all sectors are above a rising 200-day moving average, which tells us that any pullback or decline or deeper consolidation will likely just be transitory. Well, let's call it a wrap. So until next month, as always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with April 2017's Charts on the Move.